Welcome back to the Am I Rich Yet podcast, a weekly podcast for millennials and Gen Zs where we help you save, spend, and grow your money smarter. Welcome to episode number 18, where we talk about how investments are taxed. We covered investments in previous episodes, and now we're going to be talking about how they are taxed. My name is Georgia. I'm one of your co-hosts. I myself am a Gen Z, currently studying my Master's of Business and navigating my personal finances.
I am Rob. I am Georgia's dad, a recently retired financial advisor, and I'm here today to help you make smart decisions with your money. Today's podcast is going to be some heavy lifting for some of you. Just like sometimes when you were at school or university or college, you had the odd class where it was like, whoa, I need to do this early morning because there's some heavy lifting. So that will be today's podcast. You're forewarned.
I like that. So buckle in and listen up and welcome to the podcast. Now, today, before we jump in with our question of the day for each other, I want to point out something here. My dad and I, if you're not watching, if you're only listening, we are sitting on either end of a little tote bag here that has a beautifully written font that says Am I Rich Yet, which is the name of our podcast. And I had two very special people in my life contribute to this item right here. Hannah Richardson, which is my friend and dad, one of your friends, she made us these tote bags and surprised us with them this weekend. And not only was it an effort for Hannah, but Emelisa and Nicole Grella made the font for this podcast, and they're also the ones who put together our podcast cover photo and most of the photos you'll see on our social channels. We're calling it out because I just think it's so cool and special how we have had so many people, friends and family, come around us and support this podcast. It's been quick. We'll have started and finished within a 4-week period, and none of it would be possible or as fun without these people around us. It's been really special.
So how are you today?
I'm good. I have a good question ready. So my question for you today is, which of our family traditions is your most favorite?
Without a doubt, homemade gifts. So we had it in my family before, and everyone had to make homemade, a gift for everyone in the family, or you could make a bigger gift for the whole family. And so we have carried it on to our family, the 5 or now 6 of us with Mary, and you either do it before Christmas or just after Christmas. And so it helps to extend the holiday a bit. In our family, we do it afterwards, and we enjoy it probably as much as the regular gifts themselves. You get to be creative, you get to have some fun, and some of those gifts have been wonderful.
It's really cool to see what people come up with.
Sure. We do have some heavy lifting, George, so I think we should...
No question for me today. That's okay. So let's get into today's podcast. We said at the beginning we are going to talk about how investments are taxed. Why don't we start off, Dad, kick us off with what are the basic type of investment incomes?
Without going into detail, I'm just going to run through the list, and then we'll cover each of them separately. But let me start with the number 1 would be interest income. Number 2 would be dividend income. Number 3 would be capital gains. Number 4 would be deferred capital gains. Number 5 would be capital losses. Number 6 would be rental income. So there's lots of different types of possible income from investments.
Got it.
Next concept I want to go through is the difference between your average tax rate and your marginal tax rate. So let's use a simple example. You make $100,000 of earned income in a year. You pay $25,000 in tax for that year. What is your average tax rate?
25%.
The lady wins the prize, okay? 25%. Now, that is your average tax rate. Whatever your income, if you made $60,000 and you paid $15,000 in tax, that's your average tax rate. It's just the average. It's not anything to do with your tax refund or whether you had to pay. It's just how much did you pay in taxes on average compared to your income. Marginal tax rate is if you earned $1 more what percent would you pay in tax? And it's much higher than your average, unless your income gets over $1 million. And then the two sort of just move together.
Okay. So when does your...
If you earn $100,000 plus $1, what would you pay tax on that dollar? 25% or something higher? Something higher. 40%. It's actually 42%. That would be your marginal tax rate. Each additional dollar you earn, you pay 42% tax, you only get to keep 58. Once you get above 200,000, you get into that 53.4% marginal tax rate, which is the top rate for those in Ontario. And it's not dissimilar throughout the other provinces. Some are a little higher, some are a little lower. If you want really low taxes, you move to Alberta. That's the best place to be in Canada. If you want the worst place to be, I think it's Quebec. Not much different than Ontario.
Two things. One, there's only two options for
Right.
marginal tax rate. If you're making under $200K a year or over $200K.
No, there's all kinds of different tax levels. I won't
Okay.
go through all those today, but it's graduated. So on this, you pay 20% tax. On this level of income, you pay 30% tax. On this level of income, you're 40, and then you get to 50, and then you get to 52. So as you move up the ladder, your taxes go up. They're basically taxing those who make more money.
Yes.
And if your income is really low, less than 20,000, you pay no tax.
So the tiers that you just explained.
They pertain to the marginal tax rate. The average is just the formula. I paid $20,000 in tax, I made $100,000, my average is 20. But my marginal is 42%. If I made another $10,000, I'd pay $4,200 in tax on that $10,000. This, because it's complicated. Remember, your average moves slowly, your marginal can move very quickly. So it does play a role. Okay, so let's go through the easiest one, interest income. Interest income comes from cash, a GIC, or a bond. We talked about those in different investments back in a previous podcast. It is fully taxable, okay, so it's taxed at your highest marginal rate, whatever you happen to be at that year. It gets added on to your income. If you have your earned income plus investment income, well, let's use an example. $100,000 investment, 3% interest income, you'd earn $3,000 worth of interest income. That $3,000 would go on top of your employment income. So very safe, very secure, but highly taxable. So I don't love interest income.
And it's banks that are paying you this.
Banks or whoever you gave the money. If you gave it to a bank, you put it into a bond, you put it into a GIC, that's who's giving you the interest.
Got it. Okay.
Next up is dividend income. So when companies or mutual funds or exchange traded funds push out the profits of the company to you, they typically do it quarterly, so every 3 months, and it is called dividend income. So it's basically you're sharing in the profits of the company, the mutual fund, or the exchange traded fund. Some people love that income. The banks in Canada often pay 5 to 6%, depending on where the stock price is, of dividend income. And it's taxed at a lower rate than interest income. Okay?
It's taxed at a lower rate, and you explained how dividend income is typically paid out quarterly. How frequently is interest income paid out?
Typically monthly.
Okay.
So here's where it gets a little complicated. How dividends, let's say you have a $10,000 dividend. You've received $10,000 in profits from that company. What happens is they gross it up on your tax return by 38%. So they actually make it, looks like it's $13,800 worth of income. So it boosts up your income, and then you get a dividend tax credit to offset it. But that's why it's complicated. This is where people get lost on it. The dividend is high. It's even higher on your tax return. You only earn $10,000, but on your tax return it says $13,800. And then what happens is you get a tax credit. A tax credit basically reduces the amount of taxes you have to pay. So if you had a tax credit of, say, $3,000, and you were supposed to pay $10,000 in tax, now you only pay $7,000. So that's how dividends are tax credit. Basically, the tax credit is equivalent to 15% roughly of the grossed up amount. So the income was 10, We grossed it up to 13,800, and your tax credit will be 15% of 13,800, which is $2,073.
Okay, and tax credit for dividend income is always roughly 15%?
So if you're at the 40% marginal tax rate, the amount of tax you're actually going to pay is only 34%, not 40. So there are definite advantages to dividend income, especially for lower income Canadians. They can pay no tax on the first $40,000 worth of dividend income for retired individuals. So there's some really good advantages. We'll go into those maybe when we get into tax strategies.
Okay.
Next up, capital gains. You bought an investment for $10,000, it grew to $15,000. That's a $5,000 capital gain.
Capital gains are only on investment properties?
Nope, they can be on a stock at $10 a share, it went to $15 a share. Bought a mutual fund at $15 a unit, now it's $20 a unit. So it can be on anything, real estate, anything that goes up in value. It's a different type of income. It's income from the increase in the value. It's not dividend income from profits, and it's not interest income, which is just pure interest.
Got it.
If you purchased a mutual fund, let's say you put in $50,000 into a mutual fund, and by the end of the year, it grew to $55,000. So from 50 to 55, that's a $5,000 capital gain. If you sold it at the end of the year, you had a $5,000 capital gain, you'll pay taxes at half of in this country, 50%. So if the gain was $5,000, you'll only have to pay taxes on $2,500, half the gain. And then it fits into your marginal and average tax rate formula after that. So why capital gains are preferred? Because they're only taxed at half, whereas interest income is taxed at 100%.
Interest income is taxed at 100%, but capital gains is...
You're paying a lower level of tax.
Yes, it's only taxed at 50%.
So if interest income is taxed up here and dividends taxed here, capital gains are taxed down here. So it's preferred. You're taking more risk. You're not binding to the profits. You're hoping that thing goes up in value, which doesn't always happen. So what do you think if it goes down in value? You put $10,000 into a stock, and by the end of the year, it's only worth $5,000. What do you think that's called? If it's called a capital gain, it's going to be called a capital
loss.
Absolutely. If you sold the investment at the end of the year, you can take half of that loss. We lost $5,000. $2,500, and you can use that to offset anything you made a profit on. Capital losses are also okay. You don't like it because you lost money, but at least you didn't lose the whole. So those are capital gains, capital losses. We're going to cover the next one, which is deferred capital gains. This one's a little different. Put $10,000 into a mutual fund. By the end of the year, it grew to $15,000. Or a stock. Went from 10,000 to 15. You decide not to sell. You have to pay no taxes that year on that $5,000. You've deferred it to the future. So one of the great things you can do with investing is when you get to defer income, it means you defer tax. And if you defer tax, you got more money to work with. Okay? So let me use the simple example. We'll go back to our 10,000, 15,000. If we deferred that gain, we didn't trigger it, we didn't sell, we held on to it, I still have the $15,000 working for me next year. If I triggered the gain, I will only have $13,750 working for me because I had to pay the tax. So I've now got more money working for me. This is the power of compound interest. You're making money, on your profits.
And you still will be taxed.
At some point.
A greater amount of money will come off that, but the idea is that the money's already compounded, you've made more. So even though a higher dollar value is being taxed if you deferred it to that next year, it's still more than what you would have had in that first year.
Absolutely. So think of it this way. If you can defer that gain, sometimes you can't, but if you can keep deferring that gain year after year and it keeps going up and up, you're paying no tax. And you've got all that money still working for you. Whereas if the company's paying out all these dividends to you, you're having to pay tax every year on the dividends. So that's why I love capital gains so much. I would prefer you have a strategy where you take investments that aren't paying high profits to you, that they're deferring as much of those capital gains as possible. So typically one of the investments I use only triggers about 2% of the gain every year. So I've got 98% of my money still working for me. Next, rental income. We talked in a last podcast about investment real estate. So the income that comes off investment real estate is called rental income. It's taxed just like income or interest. It's taxed at the highest rate. So you don't love it, but the beauty is you can offset any of the expenses you've had in managing that property.
So far, if we're listing it from like highest tax investments, we'd at the top for being highest are interest
Rental income.
Next comes
dividend income,
and then next
capital
is
gains.
Capital gains.
And deferred capital gains are amazing, and capital losses, even though they're a loss, are still an advantage.
Great.
Okay, when an account is registered, the beauty is you don't need to worry about the type of income. When it's in an RRSP, a tax-free savings account, a first home savings account, a locked-in retirement account, all of those types of accounts, whatever the income is, it doesn't matter. It doesn't matter whether it's dividend, interest, capital gain, it's all treated the same. You don't pay taxes on it. So it doesn't matter what type of income was generated. It's only in your taxable accounts that you need to worry about all these types of income.
And which are your taxable accounts?
Your open account, we talk about investment account or cash account, the account that isn't registered. Probably at the stage most of this group is at, they'll have trouble saving enough to top up the RSP, top up the TFSA, top up the FHSA. If they still have savings they can do, then it's into an open account, then they need to worry about all that types of income. If you're a little older, you're maybe 40 years of age and higher, you need to worry about how all that income is taxed. Because you typically at that stage got an open account or an investment account. There was one account we didn't touch on. It's called an in-trust account. It's designed for those who are under 18 years of age. We're not going to cover that in today's podcast.
Now, let's reiterate it for the listeners. If you had $300 to save every month, is your best place to put it in a registered account or an open account? Registered, yeah.
100%. Because on two of them, the first home savings and the RSP, you can get a tax deduction. And then you can get even more money working for you.
Wonderful.
So I think that brings us to the end of this week. What's coming up next week, Georgia?
Next week, we're going to be covering income tax strategies for Gen Zs and millennials. And if you want to kind of wrap up today's episode, what's the most important takeaway people should have?
Taxes are really important. Everyone worries about what their rate of return on their investment is. No, what's really important is what's your after-tax rate of return on your investment. That's what's really important. Taxes are just as important as the rate of return that you get. And if you don't think they are, they are.
It's a great call out. Thanks again for being here and listening to another episode of the Am I Rich Yet podcast. We are excited to talk to you guys next week and cover income tax strategies.
Don't forget to like our podcast, follow them on YouTube, Instagram, and TikTok.
Thanks, guys.